Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Think Robert Kiyosaki and the book Rich Dad Poor Dad comes to mind. Now, my introduction to the book happened at a humble roadside stall mere days after I had landed in the bustling chaos of Mumbai. To be honest, I wouldn't say that I was blown away by the book, but it did leave a good impression on me. The book has done a great job in helping understand the importance of asset building, business ownership, and above all, long term wealth creation. Now, why am I suddenly talking about Robert Kiyosaki though? Has he come out with another international bestseller? Well, this time he hasn't come out with a bestseller but with a bold prediction. Yes, that's correct. He is of the view that we may be at the doorstep of the biggest crash in history. Here's him. The everything bubble is bursting. I'm afraid this crash may be the biggest in history. Germany, Japan, and America have been the engines up to now. Unfortunately, our incompetent leaders led us into a trap, giant crash. I wrote about this crash in my book Rich Dad's Prophecy. This crash is going to be bigger than the 1929 crash, a crash that led to the Great Depression. Now, although I agree that the macro uncertainty is the highest it has been in recent years, it is difficult to tell whether it will result in the biggest crash in history. And even if it does, its timing is impossible to predict. While the single biggest source of this uncertainty is President Trump and the tariff volleys that he has hurled at us ever since his appointment. Trump wants to make it difficult for goods produced in countries like China, Mexico, and India to be sold in the US and instead wants to enhance the local US production. This is easier said than done though. On the one hand, while greater tariffs will increase the cost of goods entering the US market and could thus stoke inflation fears, there is also the risk of other countries retaliating to Trump's overtures, thus leading to a possibly chaotic situation. In fact, this uncertainty has already led to a lot of wealth destruction globally, with the US alone erasing a whopping US $4 trillion worth of shareholder wealth. Perhaps Mr. Kiyosaki is extrapolating this very crash to a size that will place it amongst the worst in history. To be honest, the events of the past few weeks have gotten me worried as well. For we can calculate the motion of stars, but calculating people's madness and their fears are beyond any of us. Having said that, this is not the first time that the global as well as the Indian economy has faced a crisis like this, and this won't be the last either. Hark your minds back to the previous crisis of a similar or a bigger magnitude, and there's one clear takeaway. The best companies across the world, as well as in India, would be setting new profit records 10 years from now. Let me repeat that. The best companies in India would still be around 10 years from now and would be recording the highest ever sales as well as profits. Now, talking of best companies, these are the 30 stocks that were the best companies in India back in December 2007. Yes, that's true. I define these companies in India as the best ones back in 2007. Now, the reason they are the best is because they clear my filters of having almost zero debt on the balance sheets and a return on equity of at least 15% for each year for the last 10 years. Let me repeat that. These companies were the best back in 2007 because they had almost zero debt and had a return on equity of at least 15% for each year for the last 10 years. Now, an equal weighted portfolio of these 30 stocks was up almost 5 times over the next 10 years. Rupees 100 invested equally amongst these 30 stocks would have become almost rupees 500 over the next 10 years. And how much was the Sensex up during the same period? Well, it was up only 68%. Yes, that's right. While the Sensex was up only 68% between December 2007 and December 2017, a portfolio of the best companies based on my definition of high ROE and zero debt was up almost 5 times. The portfolio of the best companies was a huge outperformer over the 10-year period. Now, why did I choose December 2007 as the starting date? Well, because it was right before the subprime crash of 2008. Technically, this was one of the worst times to invest in the stock market, and still, our portfolio of good quality companies did quite well over a 10-year period. Hence, this is a big lesson for those who are not investing right now because they are worried about a big stock market crash. As long as you invest in very good quality stocks and have a long term horizon in mind of, say, 7 to 10 years, you don't have to worry too much. History says that you could still end up with market beating returns. Of course, companies in weak fundamental position or leveraged balance sheets may certainly find the going tough or may even perish. However, there's little reason to worry about companies in strong competitive positions and rock solid fundamentals. As a matter of fact, a substantial fall in the stock prices of these companies would be a reason to rejoice rather than fear. Hence, we do not know for sure whether Mr. Kiyosaki's prophecy will come true or not. Even if it does, I would like to think of it not as the biggest crash in history, but rather one of the best buying opportunities of our lives. In fact, if you believe that history does not repeat itself in the stock market, but it certainly rhymes, then take a look at this set of 30 stocks. These are the best quality 30 stocks as of today based on the way I define them. That is, a return of equity of minimum 15% in each of the last 10 years and an almost zero debt balance sheet. Now, please note that this is not a recommendation and you are requested to do your own due diligence before considering an investment in them. However, if your investment horizon is 7 to 10 years and if you're looking at investing in very good quality stocks, this list may not be a bad place to start your research from. So keep some powder dry if you haven't already and stick to your stock picking philosophy. As long as you're buying fundamentally strong companies and have a very long term orientation, you should be okay over the long term. Yes, your portfolio could suffer disturbing declines from time to time, but you will most certainly end up with very good long term returns. So ignore the macro and focus on individual stocks and the underlying quality. Happy investing. This brings me to the end of this session. I'll see you again in the next session. Goodbye, and once again, happy investing.